Hey everybody, it's Will. Today is September 5th, 2014. I just wanted to make a quick video about gold. What's going to happen with gold in the short term? That's a lot of questions I get from my friends. What's going to happen in the long term? And this video is going to be a test video. I'm going to give a few thoughts about it, see what kind of response I can get. If I get a decent response, I'll probably make more videos like it, maybe a little longer or just more videos in general. If I don't get a good response, maybe I get like 30 views and it's below average, the interest isn't there, I'll probably just keep my ideas to myself on this subject and talk about other things. But in the short term, in order to analyze the price movements, we have to analyze the nature of gold itself. What is gold? Gold is a commodity, and generally on the supply side it's hoarded. People hold on to their gold and they tuck it away, and it's depletable. It's like oil in that once it's gone, it's gone. We're not going to find any more unless, a solid gold meteor crashes into Earth, in which case we're all dead. So it's like oil in that it's depletable, and generally oil and gold follow that same trajectory. And I think that might be one of the reasons why. But how is gold different from soybeans? Well, soybeans can be hoarded. They're not, but they can be. You can store soybeans, but they're not depletable. They grow back every year. So that's an agricultural commodity that's slightly different. But gold, on the other hand, is different from oil because oil is not hoarded. It's a liquid, and that liquid's highly flammable. So the risk is too high to hoard oil. Now, what does Hotelling's theory on depletable resources say? Hotelling's theory is that the depletable resource will rise at the price of the interest rate, or the coupon rate, in the long term. In the short term, though, we're having rising interest rates in the United States. The Federal Reserve expects a strong recovery and the rates to rise, most likely sometime in 2015. They're actually debating that every day. So let's just assume it's 2015 and interest rates rise. I've got a piece of gold in my hand here that is, I believe, going to raise at 1% every year. Meanwhile, the interest rate is, let's just say, 25 basis points. So if I were to take my gold and convert it into cash, I would be losing 75 basis points every year. And that's my opportunity cost. So obviously, I won't be converting that into cash. There's no incentive. But what if the interest rates rise? Let's say they rise to 0.5%. Well, then there's more incentive to convert it into cash. But it still makes sense for me to hold gold if I believe it's going to be at 1%. Now, other people might not think that, so they'll convert their gold to cash. And so in the short term, we're going to see, as interest rates rise, and I believe this is already happening, as interest rates rise, more gold will flood into the market, and that'll push the price down. Now, within the last week, we have been seeing the price go down. There was some strong data in the beginning of the week. Now, towards the end of the week, we got weak payroll numbers, so that actually rose the price of gold because the Federal Reserve, who knows, maybe they'll delay the interest rates rise. But in the short term, gold has been falling, and it's been looking pretty bearish on the short-term charts. And again, I believe that's because Hotelling's law. And Hotelling's law, like I was saying, in the long term, gold is going to rise, or any depletable resource will rise with the interest rate. Actually, historically, though, that's been a bad indicator. The interest rate has been a bad indicator for depletable resources. So you got to take Hotelling's theory on depletable resources for the logic behind it and not the empirical data. And in the long term, though, I believe this rise in interest rates will probably help gold, for one, Hotelling's law, and make sure to look at that up so that way you fully understand what I'm talking about. For one, Hotelling's law, and for two, just the fundamental pictures of the global economy. So how can you combine the short term with the long term? Well, in the short term, if you believe gold is going to fall, hold on to your gold. If you believe it's going to rise in the long term, and potentially add to your position, it's a good time to do so. Especially if interest rates are falling in the ECB, that makes the dollar stronger. Most gold in the world is purchased with dollars, like oil, and so you know, you get the dollar to be stronger because the euro falls, and so that pushes price down on gold that is bought in terms of dollars. So that makes a good opportunity for those holding dollars to convert it into gold while it's low. But there's a few other things involved with that, and that's geopolitical tensions. Normally, conflicts in the Middle East and Ukraine and such right now are short-term fluctuations. Now, this summer we've had really low volume in the gold market, and so every time there's a new geopolitical tension, the price of gold would move accordingly. If it got worse, the price would go up. If it got better, the price would go down. However, if it turns into a long-term war, then the price will probably rise, and that will continue to rise until the war is over. So generally, geopolitical tensions are short-term indicators, and this overall strength of an economy is a long-term indicator, not a short-term indicator. So if you think the U.S. economy doesn't have legs to stand on, then you might want to buy gold for the long term in this dip. And personally, I believe the interest rates that have been rising in the United States and falling in Europe have made gold more attractive to buy in the short term if you have that long-term perspective. And I personally believe most of that rise has been priced into gold already, and that's why you've seen this huge dip. Not huge, but a decent sized dip in the price of gold. So personally, I believe most of that has been priced in already, and so who knows, maybe we're at a bottom in the gold market. And for those of you who are gold investors and looking at gold, this could be a time to buy. Personally, I'm going to wait a little longer to make my purchases once the dust settles, and who knows, maybe probably gold has a little ways to go down, because the Fed is so uncertain about what they're doing. It's some of that uncertainty isn't priced in yet. So as the Fed becomes more as they become more solid in their announcements, and they don't try to beat around the bush, then we might see the price of gold fall even further, and then that's why you might want to buy. But as for now, it's up to you. Either way, if you think gold's going higher, you could just buy now. It's not a big deal. But anyways, that's my take on the gold market right now. And go ahead and post your comments below if you have something to add, if I forgot something, and if you think Hotelling's law is valid or applicable. And if I get a decent response, a decent amount of views, I'll probably make more videos like this, so talking about gold. Anyways, take care everyone, and have a good weekend.